and well, good afternoon. It's 3 o'clock and this is a webinar about customer lifetime value. Welcome everyone. It is a seminar and a webinar organized by Civitta, the largest independent management consultancy in Central Eastern Europe, and it's supported by Estonia-based VC capital firm United Angels VC. The webinar is going to last for about 1 hour. It has 4 presentations altogether. You're very welcome to ask questions. Please just type them into the chat and we will try to answer all of them once all of the 4 presentations are over. My name is Riivo Anton. I'm one of the original co-founders of Civitta, but over the past 3 years, I've been focused on early stage tech investments in United Angels VC. Couple of words about Civitta. As told, we are the largest independent management consultancy in Central Eastern Europe. We also operate in Scandinavia, altogether in 15 countries with around 300 of staff. These are the presenters of today. Please do not hesitate to contact us, any of us, should you have any questions, discussion points or proposals after the webinar. And without further ado, I would start with the talk about the matter of today, customer lifetime value. And actually, we believe that this webinar might become interesting or useful for a wide variety of companies, definitely banks, insurances, startups operating on a subscription-based business model, but even maybe traditional companies who plan to go online or establish decent, loyal customer base. So my introduction will be quite short, easy and light, and I will also add some experience I've gained through my work as an early stage investor. So first of all, what is customer lifetime value at all? It is an estimate how much money the customer will bring your company during their lifetime as a customer. So basically it shows how much money you will earn throughout the time that the customer is actually your customer. And often enough, customer lifetime value is calculated through revenue. However, sometimes it makes sense to calculate it through profit. So be mindful about your baseline numbers when calculating customer lifetime value. Why is it important to understand customer lifetime value? And of course, there are many business benefits, but here are the 3 of them. So first of all, actually, you can observe your business risks. You can see what is really happening here in your customer base. Maybe, you know, some of the segments are buying more than usual. Some of the segments are buying less or not buying at all. So, you know, you can really indicate those risks and try to do something about it. Secondly, you can optimize your acquisition channels. So acquisition channels are the channels through which you are acquiring your customers. And by channels, actually, those customers that you're onboarding might really act differently. And of course, it makes sense for you to invest more into the channels that bring in more of beneficial customers. And thirdly, once you know your metrics, you can really start building on your customer base, meaning that you can increase the value of the customers in particular segments. Now, of course, this wouldn't be a proper webinar of a post-COVID crisis time if there weren't, you know, a slide about new reality. And I think there are some maybe aspects why customer lifetime value is even more important than it used to be before. So first, from an investor point of view, I guess investors are more careful and mindful about their investments, and they really want to invest more into fundamentally sound businesses with decent and well-proven unit economics, rather than support unclear valuations or hyper growth. So I think investors are really more looking at your metrics, including customer lifetime value right now. Then, surprise, many businesses are moving online, and many of them are forced to move online. And software as a service business models are more, and also customer lifetime value plays a larger role there. And thirdly, we can already see that the cost connected to acquisition is changing. So many of the traditional channels, such as maybe traditional media, is actually becoming cheaper, but many of the online channels might be also getting more expensive because of the increased demand. Getting more into the topic, often enough, I get questions. Okay, what are the key metrics that investors are actually looking when analyzing a prospect? And of course, everybody would like to see a business where customer acquisition cost would be smaller than client lifetime value. And, you know, it makes total sense and probably is no news. However, people know that, but still ask, like, okay, but how much should the customer lifetime value really be higher than the acquisition cost? And as a rule of thumb for any digital business, I guess customer acquisition cost should be 3 times lower than lifetime value. So if you invest €1 into the acquisition process, the lifetime value should be at least €3. Now, there's another angle how to approach this, and many of the VCs really calculate how much time it takes to earn back customer acquisition cost. It's really different in terms of segments. So here's a table on the slide where you can see that in B2C segment, maybe it can be, you know, the payback period can be up to 1 year, depending on the type of the service or product. It's shorter for the products or services which have no contract, and slightly maybe higher for the ones that have a contract. But anyways, in B2C, the annual client value is quite small, and therefore also the payback period should be shorter. Typically, I'd say up to half a year, maybe in some cases up to 1 year. In B2B, things are a bit different, and many of the light B2B services, SaaS services, still fall into category where, you know, the customers annually would pay maybe, you know, up to €12,000. And in this case, typically what we would see is that the acquisition cost needs to be paid back within half a year. Further down the road, when maybe the services get more complicated and more tech heavy, the payback period could be even longer, up to 2 years. For example, in case the customers pay more than 50K per year, maybe, you know, infrastructure, IT infrastructure is a good example of such service. So it's good to remember that the payback period is actually dependent on the amount of money the customers pay you. Then often enough, early stage startups have a bit of like challenges when trying to explain or think about their metrics and customer acquisition cost and lifetime value. So here are some of the challenges that I've seen quite often, and maybe some suggested action, like how to overcome those or how to think about them. First of all, of course, if you're early stage, then you just might not have enough data to understand whether your numbers are right. You know, the numbers might not be representative. So the way to go about it is that you could just establish those two numbers, whatever your calculations show that they are right now, and then introduce strategies like how to start pushing them apart. Because what investors really look for is they want to see companies which can increase their customer lifetime value and decrease their customer acquisition cost. So, I mean, you will need to introduce and explain what are your strategies to achieve that. Secondly, many entrepreneurs have not experienced the situation where the acquisition channels are not scaling. What do I mean? So often enough, it's like this, that if you invest €1 into an acquisition channel, say like a Facebook ad, you cannot, and you receive pretty good results, you cannot expect to have the same results once you start investing, let's say, €1,000 or €10,000. So those channels tend to max out a situation like this on the graph on the right, that, you know, you first get quite a bit of new customers, your return on investment is pretty good, but then it maxes out. And what makes sense is to try to think of what could be the solutions once the channels max out, because in many cases, and usually it's sooner than later. Then thirdly, we can also talk about a problem where companies tend to focus really on a single KPI. For example, churn. Revenue and churn are actually very, very common KPIs that companies are really like religious about. However, the problem that might be with such an approach is that actually the health of your business is dependent on a set of KPIs, and the very few of them might just give you a false picture. So imagine a situation where your churn would be decreasing, and this is generally a positive thing. And you just overlook the fact that your lifetime value of the clients is actually decreasing. So if you just see, you know, one of the KPIs, you might think that the business is getting better, but actually, you know, the sum of those two, decreasing churn, but also the decreasing lifetime value, probably is actually a negative thing. So it makes sense to look at those KPIs as a whole and more holistically. So that was a very short intro to lifetime value, and it's my pleasure to give floor to Rokas, who will now really into the matter and explain you how to calculate lifetime value. So Rokas, please, floor is yours.
Thank you, Riivo. Good afternoon, everybody. Greetings from Vilnius. My name is Rokas. I'm a partner in Civitta, Lithuania, also one of the co-founders of the company. I am very passionate about customer lifetime value topic, and I'm actually very glad to see so many participants, more than 160 I see in this webinar. So very cool. So I will talk about how to calculate customer lifetime value. My part will be more technical. We will dive into numbers. Actually, there are 4 methods how we can calculate customer lifetime value, from simple to advanced, and I will review all of them. So we'll start with something simple, and then we will move to more advanced topics. So method number 1. We can calculate customer lifetime value based on some simple assumptions. For example, I have a customer, he made one transaction. The value of that transaction is 30 euros. I am making an assumption that this customer will make 5 transactions before he churns. As a result, my customer lifetime value is 30 times 5 is equal 150 euros. So this is, and we can make, you know, more assumptions and adjust our calculations. So this is not ideal method to do customer lifetime value calculations. The first one, the simplest, but it is a starting point. Method number 2. there is actually a simple but very useful formula for customer lifetime value calculation. So customer lifetime value depends on 3 variables. It is equal to revenue per user multiplied by gross margin divided by churn rate. Let's look at this example. We have a customer who has the following KPIs. Monthly revenue per user could be 10 euros, profit margin 80%, monthly churn rate 5%. When we plug these numbers into the formula, we basically get that customer lifetime value is equal to 160 euros. We can think about this in another way, that revenue of 10 and gross margin of 80% basically gives us 8 euros profit per month. Monthly churn rate of 5% basically says that this customer on average will stay with us 20 months. When we multiply 8 times 20, we get 160. So this is actually, quite a nice and cool formula that allows us to measure customer lifetime value. So once we know this formula, we can start tracking these numbers, these KPIs regularly, and see how does that affect customer lifetime value. So for example, we might have a situation that we are tracking that our customers have a monthly ARPU that goes from 13 euros to 14 euros. Gross margin per customer fluctuates between 70 and 80%. Churn rate, monthly churn rate is also, goes from, 6 to 7%. As a result, lifetime value of the customer goes from 150 euros to 170 euros. So this is actually, quite a good way to start measuring our lifetime value quite regularly using this simple formula. The beauty of this formula is also that it basically shows us what we can do in order to improve our customer lifetime value. In order to improve customer lifetime value, because there are just 3 ingredients here. First of all, we need to try to increase revenue per user, that is 1. We need to try to increase gross margin, profitability, and we need also, to lower the churn rate. So this gives us quite some, good starting understanding, what do I need to do in order to improve business results. We can also compare different scenarios. For example, what is better? Is it better to have a scenario where the monthly ARPU is 10 euros and the monthly churn rate is 5%? Or rather, can I give 20% discount and reduce, my ARPU to 8 euros, but have a churn rate that is 3% instead of 5%? So you basically plug these numbers into the formula and you are able to see which scenario is more beneficial for the customer. So this is actually, a very, very, good and useful formula. If you're not using it, I encourage you to remember this formula and start using it in your business. And actually it will help you a lot. Now, the problem with this method, though, although it is, a very good and effective formula, the problem with this method that churn rate drastically changes with the maturity of the customer. And I would like to stress this, point drastically. Let's look at the second, slide. And here is basically a typical behavior of our customers. If we acquired a cohort of customers and we tracked their behavior over time, we would see 2 things. First of all, churn rate during the first month after acquisition will be very high. It might be as high as 40 or 50% per month, basically. And then after some time, it stabilizes to much lower levels. So in this example, imagine we acquired 1,000 customers. We are tracking their behavior. After month 1, we are basically losing almost 50% of our customers. After 2-3 months, churn rate stabilizes to 2-3% per month. And this behavior is very typical for many, many industries. If you are a telecom provider, like a prepaid card, this is how your customer behavior will look like of new customers that you acquired. If you're a financial services provider, this is how your customer behavior will look like. If you're a transportation services provider like Uber, this is basically how your customer behavior will look like. And I cannot explain why, but we have seen this in many, many industries, and this to me is fascinating. So the point is that we cannot just use one number of churn rate, like in that example, 5%, we plug it and we get, you know, a lifetime value, because the churn rate is changing over time quite drastically with the maturity of the customer. So now this gives us a third method how to calculate customer lifetime value. So customer lifetime value needs to be calculated, taking into account the cohorts. And basically, customer lifetime value is the sum of the revenue or profit area below this customer survival curve. I mean, you can imagine that you acquired a customers, they're churning over time. So basically, you know, their revenues are also, you know, churning. And we need somehow to project how these revenues will be in the future. So basically, with this method 3, there are 2 ways how we should calculate, you know, customer lifetime value. First of all, we need to observe for 6 or 12 months how our customer cohort is behaving and calculate how much money they already, you know, brought to us. Like in this example, it could be, you know, 100 euros on average, a cohort of customers, you know, brought to us during the first, you know, 12 months, you know, from the acquisition. Now we need, as a step 2, we need to predict how much these customers will spend in the future. The 2 most important variables, you know, in this case will be long-term churn rate and long-term ARPU. So in a way, we are making a cash flow projections for the group of these customers, and then we are summing that up. And this will be our customer lifetime value. And if we really, you know, want to be, you know, precise with the customer lifetime value calculations, we also need to take into account time value of money and discount those, you know, projected cash flows. We can extend this analysis and do it, you know, for different, you know, cohorts and different segments. Like in this example here, we are tracking, you know, 3 customer segments. Again, the most 2 important variables that will influence our customer lifetime value will be ARPU or gross margin, depending, let's say, whether you're able, I mean, to measure gross margin for your customers. But suppose, I mean, at first we need to track ARPU. We need to see, you know, how their ARPU is behaving over time. We also need to measure, you know, what is the survival rate of these, you know, customer segments. And basically we multiply those 2 curves together, and this will give us a lifetime value of a customer based on the cohorts. And again, like in the previous example, we need not only to see, you know, what is happening during, you know, the first 12 months, we need to make some assumptions, you know, what will happen, you know, to these customers in the future as well. So in this example, we had segment 1, segment 2, segment 3. Basically, you see that segment 1 has lifetime value of almost, you know, 180 euros. Segment 2, 340. Segment 3, 250. So this is a cool method. This is cohorts method is conceptually the correct way to calculate customer lifetime value. That formula in method 2, ARPU times gross margin divided by churn rate, is good, but in fact it is not entirely correct. So if you're making, you know, customer lifetime value calculations using cohorts, that is very good. Congratulations. This is how you should be doing that. Now, the problem with this method, what is the problem with this method? Is the following, that even like in this example, we calculated, you know, customer lifetime value of a cohort of customers, and that cohort of customers might be 1,000 customers. And you got, okay, on average, that cohort is worth, you know, 200 euros per customer. This is great. I mean, this is, let's say on average, you will be correct. But within that cohort, you will have customers that are worth 20 euros, because many of them, you know, are churning and they have already, you know, churned. And then you will have customers that are worth 2,000 euros. So basically, but, you know, the cohorts method only enables you to see on average, you know, how much your customers are worth, but you cannot do that for individual customers. So now when we know this, this brings us to the 4th method. The 4th and most advanced method how to calculate customer lifetime value is the ability to predict ARPU, churn rate, probability that the customer is alive, probability that he will make transactions, basically to predict customer lifetime value for each individual customer. And we can do that. I mean, there is a lot of like academic literature who are studying, you know, this topic. So for example, Father Hardy, they described a couple of useful methods. Now we also, you know, have machine learning algorithms that can enhance those predictions. Basically, there are some scary formulas on this slide. I do not encourage you to remember them, but more or less this method allows you to estimate lifetime value for each particular customer. I would like you to demonstrate, you know, what you can get as an output if you're using, you know, this method. Suppose we have the following information. This is one customer that more or less we acquired sometime in 2017, July, and this is relatively new customer because, you know, what do we know about this customer? He made 2 transactions. So he spent in total, you know, 22 euros. So on average, 11 euros per one transaction. We also know more information about this customer, that, you know, the channel that he came from, what devices he using, and maybe, you know, some demographics. We also know the behavior of, let's say, 10,000 or 100,000 customers in our base that we have. So based on all of that information, we would like to predict, you know, what will happen with this customer, relatively new customer in the future. And if you use this, you know, Father Hardy method that basically allows you to predict customer lifetime value for each customer individually, you can get the following, you know, values that at this stage, when we made these calculations, when we observe this behavior, that probability that this customer is alive is actually 95%, and which is, you know, quite good. Expected number of future transactions is 80. Expected value of one transaction is close to 11 euros, and this, as a result, gives us expected future lifetime value for this particular customer, 875. Now, using this method, we can also, you know, predict more numbers like probability that he will be active next week, probability that he will make transaction next month, next 2 months, how many transactions, is it 1 transaction, 2 transactions, 3? Basically, we can have, you know, more variables, because the beauty of this method that it enables us to get all these values for each particular customer. And then, you know, what is another advantage, that we can even, you know, track what is happening, let's say, with this customer over time. So here is an example. We have this customer and we're tracking it every month. So this was July, August, September, October, November, December, January 2018. Basically what we are seeing that suddenly the probability that this customer is alive based on his behavior actually drops to 14%. More or less always we had that this customer is very healthy. He had, you know, probability of being alive more than 90%, and suddenly it drops. And as a result, lifetime value goes to 70 euros, future lifetime value goes to 70 euros, rather than, you know, 500 or 600 that we had in the past. Now, once we know this information, we can start really, you know, making, you know, some business decisions. Maybe it makes sense, because actually based on this, I'm seeing that I lost 500 euros value for this particular customer. Maybe it makes sense to give a call to this customer and try to revive him back, because that is a lot of value that I can get back. And then probably, you know, I made some action in this particular case. Again, this customer was revived, and his, you know, probability of being alive goes more than 90%, and his lifetime value again goes back to 400 and 500 euros. Now, so this is actually, you know, very powerful method to manage, you know, your customers. And actually, Stephan will talk more about, you know, what you can do with this information. But to sum up, yes, there are several methods how you can use, you know, calculate lifetime value, from simple methods to more advanced. As a minimum, guys, I encourage you, if you're not using this formula, CLV is equal to ARPU times gross margin divided by churn rate. You can do it even after this webinar. I think it will actually, you know, help you and improve a lot of, let's say, business decisions that you make. Now, if you can, try to use this, you know, professional method that would enable you to predict customer lifetime value for each individual customer. Maybe you have a data science team inside your organization that could help you do that. If not, Civitta also, let's say, has a tool that that we can, automatically, calculate these numbers. And if this is something, that you might be interested in, we could have a separate conversation. Now I will give floor to Stephan, who will talk about how we actually, work with the customers once we know their lifetime value.
Thank you very much, Rokas, and hello and good afternoon to everyone. My name is Stephan Sølver. I'm a representative of the Danish office here in Copenhagen. I'm also a pricing professional, so I've worked with pricing projects in different industries and different settings. Among those is telco, in which CLV management is definitely a big aspect in order to manage customer profitability. So I'm very excited to join you guys today to talk a little bit more about the best practices. I brought 5 best practices, and yeah, let's get started. So the first best practice I want to discuss a little bit is CLV maximization. So CLV maximization is attaining the highest possible return on investment relative to a customer benchmark. So really what we want to do is maximize our returns given a number of costs and a level of revenue over time. So for example, if we take a timeline view of customer lifetime value, here we use gross profit as a metric for value. We see that there is a element of customer acquisition cost. We can't really see here how big it is, but let's assume it's fairly big so that the entailing series of gross profit will actually have to cover that. But not only that, we also have to have a view on cost to serve. So there will be an ongoing, you can say, maintenance and servicing costs to the customer given the product or products that he or she is on. Also, there's a cost to retain, which is pretty much a once-off or a continuous, or rather at different time intervals, a cost that you would have to incur and invest into the customer to also retain the customer. So we have acquisition costs, but we also have cost to serve and cost to retain, and this is what our gross profit has to cover. Now, return on investment implies that there is an investment, and this is exactly it that we have to then figure out what to do. Now, it's also relevant to say that it's versus a benchmark, and how you decide that benchmark is again up to your customer segmentation and also your business model. But really, we could do it in 3 main approaches in terms of optimizing and maximizing CLV. So first, we want to get a view and understanding of how to do account growth. So basically, we want to sell more, and we want to sell more at a higher value to that customer. But we also want to understand that we're doing it versus a benchmark, so that we see that, okay, we're actually maximizing instead of just sort of hitting a plateau or hitting our otherwise predicted value for this particular customer. Secondly, there's also the aspect of retention. So of course, customer lifetime value is highly dependent on how well you're able to retain your customers. So you need to prolong the revenue to the point where the customer at some point is churning, or the activity is so low that you can basically technically consider that customer churned. So at some point you have to reinvest into that customer to keep the gross profit level continuing. And again, you're only understanding that you're retaining the customer because you're comparing it to some kind of benchmark where you see, okay, but this is actually an aspect of where we're starting to maximize the customer CLV. And third is also an aspect of repricing and cost reduction. So this is not a particular timestamp or a particular point in time you have to do this. This is something you can do continuously throughout the customer lifetime, where you try to get a view of how can we reprice or incrementally adjust the price of this customer, understanding that we want to gain more value, and we also want at the same time to gain more value by optimizing cost to serve and retain, understanding that again we're contrasting it to some kind of benchmark to see, okay, we're actually optimizing because we can do it relative to another group of customers or a single customer or product view, if you will. So this is sort of the 3 approaches to CLV maximization. But CLV maximization also requires a very agile approach to pricing and CRM. What that means is you have to have a fairly consistent but also case-by-case ability to work and manage your CLV through pricing. And this is an aspect of targeted pricing. Basically, you you target pricing towards something, it's targeted towards a subset of customers, a group of customers, whereby, of course, you have to, at some level, design your offerings and set the right prices, ideally in a value-based approach where you have an idea of what is the customer willingness to pay, the customer value perception, also tied to your strategy and your competitive situation, etc. And from that, you can derive a campaign or a subset of campaigns based on your overall offerings, because it's actually these campaigns which then become the critical tools in your targeted pricing to actually address specific numbers of customers where you see there's an actual avenue to get more value from these customers. And again, this goes back to the account growth. We want to drive more purchases. We want to do more upselling, maybe in some business models, some cross-selling, whatever basically you have in terms of pricing tools strategically and levers to really gain more value from a subset of customers. So the overall, you can say, aim of targeted pricing is to get more customer profitability. And simultaneously, on the more CRM-oriented aspect is you also want to have a continuous targeted engagement process in complement to your targeted pricing, because it is equally important also to basically plan your digital interaction. So considering this is, for example, some type of app platform or some kind of digital business model, and especially the digital interaction becomes super important, and your contact strategy needs to be defined and related to your pricing strategy, so that you know that for a particular type of customer where you choose a subset again, you know, well, we want to do either some type of app notification, or we want to do mass texting or emails, or maybe we want to only reach the customer when they are proactively engaging in chat in the app or on the website, etc. So this is basically your contact strategy view at the right touch points with the customer. Now, again, as a derivative of this, you also have to tailor specific communication to your customer and push it in the right way. So you have to wrap your campaigns on the pricing side with the you can say concise and crisp messaging attached to that campaign. And the purpose is, of course, to drive relevant and more personalized experience for the customer, so that once you have a campaign in place and you know exactly what you want to tell the customer and how you want to do it, that customer is supposed to feel like this is contextual and relevant to this person, so that when they do receive the offer, they're not instantly, you know, disregarding it. They're actually experiencing it as something that is completely personalized to them and something that they can really use. And you can say the aim of that is to get the customer more involved, get the customer more activated, and you can say derive more retention from that effect also, because this is where the two combine. You say you want to do more customer profitability, and you want to get the customers more activated and more retained. So an example of this could be, for example, a food delivery app, where they send me an app notification because it's tailored to me and they want that particular type of contact strategy. They say, "Dear Stephan, a personal gift from us to you. You now get free deliveries for a full week." So they have designed this campaign for me, at least that is my perception of it. Maybe there's 100 other customers who will receive it, or maybe even more, maybe less. But this is something for me to be triggered into, you know, doing more frequent purchases and perhaps also even at higher transactions value. And the reason I like to use this example is because it actually did happen to me at one point where I got this type of free gift, if you will. And it actually worked for me. So within that week, I actually ordered, I think, 3 or 4 times instead of maybe 3 or 4 times a month. So it's a very concise way to get me triggered and incentivized to get more frequent interaction with that particular app and with the service. And also I was actually spending even more money because I was no longer worrying about having to pay for the deliveries as well. So this is again sort of how to balance your pricing and your interaction with the customer, which is super important here. And thirdly, we also want to bring a very strict value management discipline into this as well, and really sort of think what is our strategic opportunities to build value in our customer base. And going a little bit back to the sort of the pro method that Rokas detailed, is that if we actually are able to get a set of predicted CLV values, we can split them into intervals from low to high, for example, from left to right here, and then get a distribution of the customers to understand, okay, what's the scale here, and how do we distribute the customers according to the amount of value that they contribute. Again, let's say that these are predicted values, so it's not something that we have actually achieved yet. It's based on an algorithm that predicts this type of value contribution for the number of customers attached. So you will most likely have some kind of situation where you have a large share of the base that contribute a very low amount of profit. And these are typically your highly inactive customers or your sort of random activations, or the type of segments where you're not really hitting them that super hard, and they don't really have that same core need for your product as other customers may have. And you may in fact have a number of customers who are actually negative profit for you, so that they're in your base, but they're not contributing any value. In fact, you're losing money on them. And then you may have a fair share of the base, which has sort of medium profit, sort of an average contribution bulk type of setup, where they're active, they're using the product, but you also want to get this big share of your base more involved, because you see there's more potential here. Again, going back to the maximization mindset, is that you have to sort of keep it relative to something. So you have to see, okay, how can we get this share of the base more involved? And then you may have a small chunk of the base, very low share of the base, but with very high profit contribution. So these are perhaps not many in numbers, but the actual profit that you can derive from them is very big. So these are the type of customers that you need to be extra attentive of and give them more attention than you otherwise would, because you need to keep them here. You need to keep them frequently transacting and at higher and higher values. So the whole exercise is basically to shift this paradigm towards a higher and higher CLV. Now, in terms of strategic value opportunities, well, then I brought a few examples here. Then you can do different ways of splitting the pie here, but this type of view also helps you to say, okay, for this type of segment of the base, we really need to get some kind of value. We know we can't do something big in the low end, but maybe we can introduce a small transaction fee to just get a little bit more juice out of that aspect of the base, or that part of the base. Simultaneously, you can also look into the other areas of the base and say, maybe if we added a cashback feature above X amount of transactions, maybe this will trigger them and get them more involved and actually get even more value from this particular aspect of the base. And these can either be in isolation, or they can be all together for all customers in the base. And finally, for the very high end, you also may want to consider strategically thinking about how do we retain these customers in some kind of loyalty program or point-based program. There are many different ways of going about this, but again, we need to keep them there, and we need to get a bigger share of the base towards more profit contribution. Now, the fourth best practice and aspect here is you also want to monitor your CLV KPIs across a range of micro segments. So, for example, here in the middle bubble here, we see that we've taken one of our high CLV segments from the chart before, and then we split it into particular micro segments according to criteria that we define. So this could be either according to, you want to look at different countries, or you want to look at different cities. You may want to look at different product groups or particular products, or however you want to sort of set up criteria for what that micro segment is supposed to represent. And then ideally, you would then follow religiously the KPIs around the CLV that they contribute. For example, transaction frequency, which is basically the amount of transactions over some kind of average. It's also important to look at average transaction value, probability of staying alive, which is sort of your key churn parameter, and also total CLV, which is again a predicted value here. And there are more KPIs that you can follow and track, and you probably should. But it's important to sort of say, okay, what is my most important segments, or what is the most important split in the base that I can make? And you can make many different types of segments, but you probably want to focus on the ones that are most relevant and most acutely either missing in value or contributing a lot in value. Fifth aspect here is, at a more tactical level, you also want to run targeted and customized campaigns to improve CLV. So this goes back to the first slide talking about, the combination of a targeted pricing and CRM approach, where you want to work more tactically with a campaign. And with the CLV model, for example, again, our pro model here is actually able to predict customers who have few or declining transactions. So accordingly, you would also want to build campaigns that stimulate more transactions. Also, it's very interesting to monitor and keep track of customers who have low or declining transaction value. And these could be the same as group 1 and 2, or it could be completely different customers. So of course, you also want to build campaigns that stimulate higher transaction value per transaction. And finally, in terms of the churn perspective, it's very important to monitor and make sure you keep an eye on customers with low or declining probability of staying alive, because this is basically the best measure of, okay, the machines or the model has basically predicted for me that these customers will not stay with me for very long, but I actually want them to stay. So how can I fix it? So you need to also, of course, look into campaigns to revive the customers. And maybe you can build campaigns that fixes everything in once, or maybe you need to do more segmented campaigns for this. But in any case, you have to consider this a iterative process, and you have to make sure that you maintain a tactical campaign toolbox. And of course, try to leverage the ones that you consider and sort of have realized to be very successful. You can sort of refine and recycle those and keep them going, and always find ways to add value according to the specific value target that you have, whether it's more churn oriented or whether it's more transaction oriented. So just a few examples towards the end of my part here. You saw this before, but we just want to focus a little bit on some of the numbers here. So with the model prediction, it's actually showing us that we have quite a significant drop in expected total lifetime value. So the model tells us, okay, this guy is going to drop in value, and we don't exactly know why. We need to figure out why. And simultaneously, the model is also telling us, well, I'm also predicting that the number of future transactions is going down. So between these two calculation dates, something has happened whereby the model then responds to this and predicts a new number. And accordingly, you also need to attach some kind of insight to this, understand why is this happening? Is it something in the market? Is it something to do with the customer? Is it something to do with our app, or whatever it may be? You then need to have an action that says, okay, we want to design something a campaign that stimulates more transactions to get this lifetime value up again. Another aspect is something like survival risk. Again, I think Rokas spoke to this, so I think we're okay, and we don't need to spend any more time on this. But basically, identify the drop in CLV, and you see, okay, but the drop in CLV again is because the machine has predicted that the probability of staying alive has significantly been reduced. So again, you need to think, okay, why is that? We need to attach some insights, look into further data, or go ask the customer, or go do something to figure out what actually created this situation, and then design a campaign to revive the customer. So finally, a quick recap. Maximization is the highest possible return on investment relative to a customer benchmark. You want to do the maximization in an agile way with pricing and CRM activities, whether that's in tribal, the sort of startup tribe teams, or whether it's more established cross-functional marketing teams. You need to figure out a more agile way to do this than the traditional sort of structured, more slow process around strategic pricing and CRM. You also need to look for value opportunities, bring in a value mindset through the analysis, and get acquainted with strategic pricing tools. And finally, you want to monitor CLV KPIs across microsegments, and make sure you keep a toolbox attached to that so that you can always respond accordingly. So now I'll put the torch forward to Eero, who's going to deep dive into customer acquisition cost optimization.
Thank you, Stephan, and welcome to the final part of this webinar before the Q&A. As Stephan said, my name is Eero Vassinen, and again, nice to have you all here, and thanks for sticking around. So you have heard quite a lot about customer lifetime value. Now it's time to take a look at the other side of the equation, namely customer acquisition cost. Looking at the slide here, you can see that this is intuitively quite obvious. You want to keep your customer acquisition cost below your customer lifetime value in order to have a profitable growth in your business. That is to minimize your customer acquisition cost and maximize your customer lifetime value. The more difficult question here is how to do this, and that's something that we will look into now more closely. So first, it's important to understand some basics. On the left-hand side here, we have something that's called a marketing funnel, which essentially describes your customer journeys with you from when they first hear about your product, which is the top of the funnel, the awareness part, to the point where they become your customer, which is the action part. Now, the top of the funnel is where you build your brand, and the bottom is where the customer conversion happens. So the sales of the actual product or service. Everything you do along your funnel is marketing and sales, and it has a cost and effect. On the right-hand side here, you have the relation between these two. So the cost and effect, which is essentially your customer acquisition cost. So this fairly simple basic model to get this started. And now we're going to show you how to study what happens inside the funnel a bit more deeply. So to help you understand what happens to your customers inside your marketing funnel, we often use something called marketing attribution or marketing attribution models. So every customer has a journey, so to speak, from when they first hear about your product and when they become a customer. And what happens in between is the customer journey. And here on the bottom, you can see a fairly simplified customer journey with some selected channels and touch points, starting from Facebook and then ending up on the website where the purchase is done. With marketing attribution models, you can track these touch points that your customers have with your brand and how those interactions affect your business and the essential conversions. The more you understand about the effectiveness of these interactions, the more you understand about your customer acquisition cost, and essentially more you understand about your customers. Now that we know the principles of marketing attribution, we can take a closer look at how this can actually be done. As always in life, there's the easy way, and then there's the right way. So first off, some of the easy ways. Here we have some simple and fairly common methods to calculate marketing attribution. The most common method by far is last click, which you can find on the top here. The idea of a last click method is that you basically only calculate the last click before the conversion. So in the previous slide, basically the Instagram ad that you had was the last click before the person became a customer. Now, obviously, this has some clear disadvantages. Firstly, it ignores everything that happens before the final interaction. So you're losing everything that's above that last click in your marketing funnel. And you're not getting that much information about your marketing actions, which is very important if you have multiple channels in use at the same time, or even running multiple different campaigns inside of those channels. So this is some fairly simple marketing attribution methods that are commonly used. Next, we're going to look at something we at Civitta like to use with our clients. It's something that we call a probabilistic method or probabilistic marketing attribution model. So here you can see again a simplified example of a probabilistic attribution model. Usually, obviously, you would have much more interactions and much more channels, as well as customers have a lot more, a lot more touch points before they converge. But now, for the sake of clarity, we've simplified this. This kind of model allows us to analyze what happens during the whole customer journey, and it allows us to understand and analyze the complex relations that happen between how these different interactions affect each other, and how effective each channels or certain campaigns are. And then they obviously help us to calculate the acquisition cost and analyze the effect. If we look at I think that the cursor works. Yeah. If we look at the lower right hand corner here, we can see that all of the conversions are basically coming from channel 1. And if we would use the last click method, that's where we would attribute all of our conversions. But as you can see on the left hand side, actually users who have passed through channel 3, who have had this as a touch point, have a much higher probability to convert actually to end customers. So we see the importance actually of channel 3 as a sort of top of the funnel channel before they move to the actual purchase through channel 1. So what happens if we take this probabilistic model and compare it with the last click model side by side? Here we can see on the left hand side we have various channels, and then the last click or last touch point marketing attribution model. We can see that brand offline is the last touch point, or most common last touch point for our customers. And in the middle here, we have the same channels and modeled with the probabilistic model. Effectively, you can see that the probabilistic model leads to a better understanding of your customer acquisition costs in the channels, as you have a better understanding of the whole chain. And using the simple last touch method over attributes the conversions to the brand direct channel. The more sophisticated probabilistic method gives us some valuable insights on the other channels and sort of their hidden impacts before they converge. And so you can see that actually here the referrals and socials, which were fairly in a small role in the last touch point model, actually are fairly important channels, but are not necessarily the last touch points. So let's look at another real life example from one of our clients. On the right hand side, again, you see the various channels and also campaigns, and then you can see the customer acquisition costs, and then now also the customer lifetime values for these channels and campaigns. So customers that have converged through these channels, what the lifetime value is. Obviously, you don't want your CLV to be lower than your acquisition cost, and this is noted with the orange color here. So these orange channels or campaigns are something that you would want to reconsider or look quite thoroughly into, and understand why customers why the performance is bad. For example, maybe the referred customers churn early, and for some reason the cost in that channel is also high. So that's something like a tangible example on how you could use this type of modeling in real life to better balance your acquisition costs with your lifetime values. Finally, to sum up, why customer acquisition cost is important to understand, and why we recommend using sophisticated models to do that. Firstly, you get to know how much it's costing you to acquire customers, quite simply. Secondly, you can dive deeper into those touch points and understand the relations inside of the marketing funnel, and really thirdly understand how the customer journey works and which communications methods, which marketing methods are efficient on various parts of the customer journey. So I will shortly give it over back to Riivo. We are just on time. Here we have the final core formula. If your customer acquisition costs are lower than your customer lifetime value, we have a winning formula for growth. Now I'll give it over back to Riivo from some Q&A. Thank you very much.
Yes, thank you. Thank you all for the presentations. We have actually a number of questions and comments. First of all, there was a question for Stephan. What campaign toolbox would you recommend? So it's about the tools to use for running the campaigns. Stephan, over to you.
Yes, so the question might be oriented towards specific software or perhaps some kind of planning process. But I would say the word toolbox is used here in terms of having a collection of tactical either products or add-ons, different types of packages, whatever it may be relating to your business model that you feel is something that you can use more continuously on an ongoing basis. Software-wise, I don't think if that is pertaining to software, I don't actually know if there's any good software. I think it's mostly an exercise in keeping track again of the KPIs and what's going on in your base, and then saying, okay, but when we do then act accordingly, we build up basically an arsenal, both in terms of analytical thinking, but also an arsenal of specific product tools or pricing tools that we can apply, again, wrapped in the right messaging. And that is particularly interesting when we look at the digital aspect, because you can't just ignore how you do it through the app or how you do it through the website. This is just as important to say, we know this pricing handle works, but we also have to make it super personalized, and we have to make it through this touch point and in general at this time for these segments. So it's this type of toolbox. It's more a mentality, if anything, than it is a specific process or software. So I hope that answers the question.
Yes, thank you. There are many questions and comments about if this session will be recorded and it will be made available somewhere. Yes, it will be available in Civitta's Facebook page, I think. So we will make it available, but more of technical questions. So what is the tool that should be used to calculate attribution with client lifetime value? And should this tool be incorporated somehow in the CRM system? So I guess it's more to Eero's question, a very technical one. I'm not sure, Eero, if you're able to answer that.
Yeah, I think R is pretty typically used in calculating these more sophisticated attribution models. If I understood the question correctly, I'm not an expert either on statistical softwares and CRM interconnectivity. So we'll have to get back to you on this if you leave your contact info somewhere.
There is also a follow-on question, potentially from the same person from the audience, asking which attribution model seems to be the best or universal to apply.
Well, yeah, I think this, there's at least two dimensions here. Firstly is what the maturity and size of your business is. So if you're a fairly early stage business, then obviously maybe a simpler model, maybe one of the models, even like a last touch model, could do the job. And then if you're a very large multinational company selling products and services, then you probably should use something that we went through, like the probabilistic model. It's more a question of I guess Rokas can fill in here, but I guess it's also a question on what your data inputs are and how sophisticated those are.
Yeah, so there are a couple of those models, and so the one that we like, which is sort of not super complex but already advanced, is Markov chains. Yeah. So basically, we take, you know, all the interactions that the customer had, I think, and the difficult point will be to collect all of the data, because I mean, first of all, you need to have maybe tools that track whenever you acquired a customer, what touch points he had before, because some companies only they track the last touch point, which is, you know, not very good, because then you would say, okay, he came directly to our website. But the thing is to have tools to track that. First of all, he saw an ad on Facebook, and then there was an ad on Google, maybe on Instagram. So once you track all of those transactions, I would say this is the difficult part, to have like the right, you know, process and tools in place that track that your new customers, how they interacted before. And then after that, I mean, there are those statistical models. The one that we use and we like is Markov chains.
Yeah, exactly. And I sort of like add to what Rokas said is the data inputs and basically how you build those campaigns and how you set up those channels to actually get the data out of them is equally important than the actual analytical model. Or more important, because you can't do the second without the first.
Thanks. There's actually couple of questions to Rokas. One that I received over SMS actually, which is like, what is the minimum amount of data that you could use to really make meaningful calculations? I guess it applies more for early stage startups. So Rokas, what's your view on that?
Yeah. So for example, if you decided to use like what I presented, one way to calculate CLV and correct method to calculate CLV is based on cohorts. Now the problem is that with the cohorts, to have somewhat statistically significant results, you need to have at least, I would say, 1,000 customers or several hundred. Yeah, I would say maybe 500 is a minimum. If you have customer samples that are less than 500, then that cohort view will be, very shaky. Yeah, so I would say it's, if you're using, cohort view 1,000, maybe, 500. The interesting thing that this, Farder-Hardy method is able quite accurately to predict customer lifetime value with much smaller segments. So for example, if you just, wanted some cohorts, you only have 1,000 customers and they came from 10 different channels, maybe there are 2 products. So that is already, 20 different cohorts, 50 customers each. To use, cohorts would be, very difficult way to say that, hey, this is, the lifetime value of this, particular channel on this particular product, because you need much, much higher, numbers. But if you use Farder-Hardy method, the one that, calculates this, let's say for individual customer basis, then basically you're able to do this even for a smaller cohorts. I mean, we had cases where we basically were able, to calculate it even, for a customer that only, has 50 customers. And because basically you're comparing that to a larger, customer, let's say base, and that method, that last fourth method, is basically enables you to work with a smaller amount of customer base. But of course, then you need probably a bit longer history. So we had a customer that only has 1,000 customers. They're basically having it's a B2B client. They have 1,000 customers. So normally I would say if it is only 1,000 customers, it will be very difficult for you to make any meaningful customer lifetime value analysis. But we applied this, Farder-Hardy method, and it was, quite beautiful, I would say. And even myself, I was surprised, because normally I would say, I would recommend guys, if you have less than 10,000 customers, maybe, forget this CLV exercise. But I think even in that case, we worked, it was 1,000. And we would be able even, to make it into smaller segments. So that worked, quite well. So normally just, yeah.
Yeah, maybe a sort of like a follow-on question, or you briefly touched upon it, is like anesthesia is what is the biggest pain in calculating customer lifetime value? So I'm assuming it's actually getting the data, right? Or is it something else?
Yeah, I would say getting the data. Yeah, so I would say first of all getting the data, and then also deciding which data to use, because of course, I mean, I don't know, probably, I mean, if you attended a lot of big data conferences, many people say, oh, you need, I mean, to gather all the data, track everything about the customer, let's say whatever he's eating, where he's going. I would actually say that most of the data is noise. So rather than, I mean, but of course, if you go to those big data conferences, all the vendors would say to you, yeah, you have to use all of that big data. But I would say getting the data is a pain point. Number two is deciding which data points to use, because sometimes if you use all the data, you might simply, crash your systems, and you might not, get any meaningful predictive incremental accuracy. So I would say challenge number two, to decide, I mean, which data is noise and which data is a signal, and use maybe, not necessarily all of that data. And number three is, of course, to use the correct models. So I would say getting the right data, first of all, cleaning that, deciding which data to use is number two. Number three is then using the correct tools to make predictions.
Got it. Thanks. Then a very clever question from Lise about prediction. So I guess the context of the question is maybe very timely. So if you're doing predictions, how and if at all, crisis or black swan type of events should be used as part of the model. And once those have occurred, should you remove them out of the model again? Because I'm assuming their frequency is like very, very low. So how to go about those unexpected sort of like events like we have right now?
Yeah, very good question. And quite honestly, really, I mean, I wish I knew the answer. And this will be like, even for many people, probably, I don't know. I think, it's really black swan. And many of those, predictive models and artificial intelligence models will simply, fail, because this is, something not typical. Yeah, because basically, like, some business was forced to close, and it is not that your customer sort of decided to choose your competitors, or something change in their behavior. Basically, I mean, they decide. I mean, they're not allowed, let's say, to buy services from you. Maybe you were like some shop, and you had a loyalty card, and he was coming to your shop and buying something regularly. Now that shop is closed for 2 months. Of course, like normal, the model would say, hey, this customer is dead, because I mean, he hasn't, done anything, for 2 months, and he was a regular customer. So like all your models, and even our model, would say this customer is dead. And of course, let's say how to really, do that. It is, I don't have, let's say, a good answer, but probably you need to make some kind of adjustments to these, black swan events. And then I think this will be a challenge to many.
Yeah, you briefly touched upon churn already. If the customer is dead, probably he has churned as well, but there's a question about churn. So what is the appropriate time frame for considering if the client has churned? And, should by any miracle they return, should they be considered as new customers or existing customers?
Okay, yeah, good question. So I would say, but look, because it depends, let's see, on the business. Yeah, I always like, and this is, I always like the definition of 30-day customer base. Yeah, so I would say that, try to track, because I mean, whenever you have, your customer base, so some companies use 1 year active customer base, 3 month active customer base, and if he's not acting, for 3 months, then they consider it churn. Yeah. So first of all, I mean, I like 30-day definition, because I like to measure monthly churn rate, monthly ARPU, monthly gross margin, because monthly revenue. So my personal sort of preference is monthly and 30 days. So that is one. But then also depending on your business, right? Because your business might be that, of course, sometimes you're using the service regularly, like maybe even weekly or monthly, but there are businesses. So suppose you are, maybe, buying, some shoes or clothes. So probably, you are buying that maybe, once or 2 times per year. The beauty of that, for example, Fodder-Hardy method, it actually, gives you 2 variables. First of all, the probability that that customer is alive. So that is sort of closely related to the churn rate. And number 2 variable that it gives you the probability that he will buy your services in the next month, on the next 2 months. Yeah? And you can define, that period. So basically that first variable, the probability whether the customer is alive, will more or less say, yes, this customer is still alive, but he's buying more or less every, 2 months. And so he will not be churned, but they will say, look, the probability that he will buy your service next month is very low because it's like he's buying, every 3 months, something like that. So I would say, like, personally, if you must, if you are like debating in your organization, what should be your churn rate, I would say use 30 days, my preference, yeah?
Got it.
But
Thanks.
Depending on your business, it could be, you need maybe these 2 variables, whether he has churned and whether he's likely to be active customer, next month. And I think, when he comes back, I would treat him as a returning customer, right? Because he's like, he's here with you, but his frequency is every 2 months. Maybe every 3 months, depending on your business.
Thanks, Rokas. There is a small Finno-Ugric name group forming up here. A question from Eero to Eero, and it's about marketing funnel slide. Formula of marketing investments versus new customers. Which number will you take as the new customer value? Is it CLV or customer acquisition cost?
The marketing funnels. Yeah, I maybe wasn't clear on. So basically, the customer acquisition cost there is the total amount of marketing and sales investments you do divided by the incremental new customers you get. So basically, if you put 1,000 euros into Facebook ads or ad, and you get out the 100 customers, then your customer acquisition cost is 10 euros, and that's the equation there.
Got it. Another question on, I think it's probably for Rokas. So what is the software you would recommend for calculating Fodder-Hardy model? Using what software would you use for calculations on Fodder-Hardy model?
Yeah. So, well, yeah, because that method is like, like econometrics formulas. So you can use any formula. It depends, let's say, any software. So it depends, let's see what you have. Maybe you have a data science team that has like MATLAB, and they're happy with MATLAB, they can use that. If they use SAS, they can use SAS. R, the most popular data science software, you should use R. So for example, we are using R, and we have, automated this process, yeah? But the thing is, whether there are some ready-made solutions for this, as I said, probably, yeah, for example, we have it, yeah? So let's say we have done it. I don't know whether there are other, let's say, in the market, like that solve this particular, let's say, problem. But again, if you have like a data science team and they are sort of know these methods, they could use, for example, R. They could analyze those papers, or if this is something that you might be interested in, we can talk and we can help you.
Got it. There's another technical question from Maiko, which wonders about the easiest way to track the exact individual customer across all different channels. So I understand the question in a sense that, through the landing page, it's relatively easy because you have all of those like tools. but what happens if it's more or less like a cross-platform campaign, like how to track a customer and what's the best tool to use. Maybe it's for Eero, the question.
Yeah, that's a great question, very topical question, and it's a €1 million question. There's no easy way to track each exact individual customer across all different channels, whether they're offline or online channels. There was a question about online and offline channels. We can maybe combine the two. So basically, this is why marketing departments and media agencies get paid for is actually trying to build methods in doing the tracking. Just on a general note, basically cookies are the technology most commonly used in online channels. The problem with that is that we have this small consolidation of these internet companies, which are controlling the majority of online advertising at the moment. You may have heard about them. They're Facebook and Google and Amazon. And these companies are pretty much trying to destroy the cookie-based advertising industry, which will make it even more difficult for marketers to track individual customers across different channels if they're not owned by basically the same holding company. So great question. Unfortunately, there's no short or right answer to this. You have to use a lot of thoughts that go into these, and there's no right or wrong way, whether it's a certain channel or a certain campaign. Yeah, sorry, maybe like quickly answer on the offline. Is it possible to establish a customer journey when there are offline and online ads during the same campaign, for example, TV and Instagram? How accurate are the probabilities for each touch point would be? Well, like a classic way to do this, again, there's a million different variations because there's a million different ways to do these campaigns, and depending on what the objective of the campaign is. But basically, you can, if you have a print ad and let's say print ad, like a classic offline channel, and your objective is to build traffic on a website or get downloads on your app, you could use different URLs or different channels, and that way track the print conversion, the offline conversion. Then you can on TV ads, you can get from networks, you usually can get the exact time periods where your spots are shown, and you can link those conversions using your own model on depending on what the objective of the spot is, and you can observe the time slots of the spots and whether those have impacts on your online channels. So there are various methods to do that. It's not the simplest or the easiest always, and of course traditionally that's why a lot of offline channels are obviously also used for the top of the funnel awareness building, which they are really effective in even still now, print advertising and TV as well, in building awareness.
Yeah. Thanks. So. No further questions.
You can always study awareness, basically, but that's, as said, the more you're at the top of the funnel, the harder it is to track the individual effects on individual customers compared to more tactical methods.
All right. Thanks. So I don't see any more questions from the channels. So really thank you, everyone. All of the crowd that have kept us busy 25 minutes more than expected because of the questions. Really thank you for joining us. Please do not hesitate to contact us in case you have questions, comments, or problems with your customer acquisition cost and customer lifetime value, our strategy and data teams at Civitta are always happy to help. If you are a startupper in early stage with a good idea and well-established metrics, please reach out to United Angels VC. And all of what we have been showing and talking about today will be available in a couple of days in Civitta's online channels, Facebook, and probably also Instagram. Thank you very much for joining us. Hope to see you soon. Bye-bye.
Thank you, guys. Goodbye.
Thank you.